Welcome to this tutorial. So in this today tutorial, we are going to cover the ender ratio analysis with a practical example. So in the previous discussion, we already discussed about various ratios like liquidity ratios, leverage ratios, profitability ratios, activity ratios, and market ratios. So in this today tutorial, we are taking a income statement and balance sheet as a reference or as an example, and we are going to prepare the complete ratios from that income statement and balance sheet. So in this today tutorial will help you to practice more ratio analysis questions and also get more familiarized with the income statement balance sheet. So before starting our analysis, let's took an example of an income statement. Here is an example for an income statement. So in this income statement, it is prepared for year 1, year 2, and year 3 for the 3 years, 1, 2, 3, 3 years. So you can see the revenue here, or we called it is top line, and the cost of goods sold. After reducing the cost of goods sold from the revenue, you can get the gross profit. So after that, we are coming into selling and general administration expenses like selling expenses and G&A, general and administration expenses. So we'll get once we reduce all the selling and general administration expenses, we'll get the operating income. So then later we'll come to depreciation and amortization and other income and expenses that get adjusted with the income statement. So you'll get the EBIT after depreciation and other income. So after we'll come reduce the interest expenses though. So we'll get the profit before tax. Then the income tax, that is 30% of PBT, profit before tax. After we'll get the net profit. So this is the structure of this income statement. So what here you can see already this is income statement is prepared with a vertical analysis. So what is vertical analysis? We discussed in the beginning. It is expressing all income statement or value as a percentage of sales. So you can see for the year 1, year 2, and year 3, the all other elements or components is expressed as a percentage of revenue aspects. So in the 3 year, you can take, we took sales as a 100%, and we are expressed the all other component as a percentage of this net sales. So you can see here the cost of goods sold is 60% of the sales for the year 1, and the GP is 40%. The selling expenses 8%, G&A 7%. So the total operating expense 15%. So the operating profit 25%. Depreciation is 4%. Is all related to sales. We are taking sales as a base. So the other income or interest income is 1%. So the interest expense we took as 3%. PBT, profit before tax, 19%. Income tax 6%, and the net profit is 13%. So all this way it's prepared for the year 2 and year 3. So there is already a vertical analysis or vertical income statement. So already we prepared a vertical income statement. So in this way we can analyze all the component of income statement, how it is behaving year to year with related to sales. So you can see the GP is 40% in the year 1 and 40% in the year 2. But when it comes to year 3, it is 41%. Like that, the operating profit also it is increased from 25 to 26 and 26 to 28 from year 1, 2, and 3. Same like the net profit also you can see there is an increase here, happened here. So in the beginning the net profit is 30% of sales, and the year 2 it is become 40%. So year 3 it is become 15%. So in this analysis we can see that this business is growing and it's showing a good income statement or good profitability in the year 3 when we are comparing with the year 1 and 2. So in this way we are comparing the income statement. We can get an insight into income statement, how it is behaving, how it is changing from year to year in various components like the revenue, the expenses, the profitability, the profit, how it is behaving from year to year. So this is you can take this as an example for an vertical income statement as well. So this is the same analysis or summary we discussed now. The sales has grown from 10,000 to 14,500. and the GP is grown to 4,000 to 6,000. The operating profit also grown to 2,500 to 400,000. And the EBIT also grown from 2,150 to 3,570. Then the EBT is grown from 1,850 to 3,170. The net profit also grown from 1,295 to 2,290. So when we are doing analysis like this by yearly, or when we are comparing our performance with the past years, so in this case the year 2 and year 3 are the past years. So if you are comparing this with the year 3, we can get an insight how this business is moving, how the sales moving, how the profitability, how the cost behaving by year to year. So let's come to example for balance sheet. Then the balance sheet we are prepared in the same way that is for year 1, year 2 and year 3. So even this is prepared vertically. That means in the balance sheet, we took total asset as 100%. On all other component of balance sheet as expressed as a percentage of total asset. You can see the cash and cash equivalent we have 10%, account receivable 14%, inventory 18%, prepaid expense 1%, the total current asset 43%. Again, the property, plant and equipment is 16%. Then the accumulated depreciation is 5%. Net property, plant and equipment 55%. And other long-term asset 2%. So when it's come to liabilities and equity, account payable 12%, short-term loan 6%, accrued expense 20%. The total current liability is 20%, and the long-term debt is 24%. The total liability is 44%, share capital 30%, retained earnings 56%. The total equity is 56%. So the retained earnings 26% and the total equity is 56%. So in this way, you can see this balance sheet is prepared as a vertical analysis balance sheet. So all other component of balance sheet is expressed as a percentage of total assets. And also when we are making comparison like this from year 1, year 2 and year 3, you can get really an insight into how each component is behaving from year to year. So you can see the total current asset is increasing by year to year. You can see in the beginning it is 43% of total asset. It is come to year 2, it is 48%. And when it's come to year 3, it is 54%. So you can see the total asset is always matching with the total liabilities. At any point of time, the total asset should match with the total liabilities and equity of a balance sheet. Here is the complete example for the balance sheet. So now let's come into ratio analysis. The first important ratio is liquidity ratios. We are taking only the key important ratios only for this analysis. So you can see the current ratio, we are calculating quick ratio, cash ratio and working capital. So we already given the formula here. The current ratio is current asset divided by current liabilities. The quick ratio, it is quick asset divided by current liabilities. The cash ratio, it is cash and cash equivalents divided by current liabilities. So the formula for working capital is current asset minus current liability. So we are preparing the ratio analysis for the year 3 only. Here you can see the current ratio. The formula is current asset divided by current liability. From where we will get the current asset and current liability? It should be from the balance sheet. You can see the balance sheet here. The total current asset 5,950 and the current liability is 2,400. So 5,950 divided by 2,400. So the current ratio is 2.48. The same way you can calculate the quick ratio. So how will measure the quick asset? You have to reduce the inventory and prepaid from the current asset. So we'll come to here. It is the total current asset is 5,950. So from this 5,950, we have to remove this 2,200 and 150. That means inventory and prepaid to get the quick asset. So here the formula is 5,950. That is total current asset minus we are reducing the inventory. Again, we are reducing the prepaid expenses divided with 2,500. That means 1.5. Again, the cash ratio. And the cash ratio, what is the formula for cash ratio? It is cash and cash equivalents divided by current liabilities. So here you can see the cash and cash equivalent is 1,800. Again, the current liability is 2,400. So that means cash and cash equivalent divided by current liabilities. 1,800 divided by 2,400, that means 0.75. Again, the working capital. The formula for working capital is current asset minus current liabilities. So in this case, the current asset is, we already discussed here for the current ratio, 5,950 minus 2,400. That means 3,550. So we already calculated the important ratios here. Again, I'm giving this PDF as an attachment with this video. You can download this video and you can practice it yourself to become an expert become more familiar with the liquidity ratios. So what we can analyze that. So in this ratio analysis, I prepared the ratio only for the year 3. So what you can do, you can prepare the ratio for the year 1, year 2 and year 3, and you can see how it is behaving from year to year. In this analysis, you can say that the current ratio is 2.48, which indicate that the company have total current asset of 2.48 types of its current liabilities. This company can cover up its current liabilities 2.4 times with its current asset. Then the quick ratio, what is this measuring? 1.5, what is measuring that? The company can cover up its current liabilities 1.5 times only using its quick asset. What is quick asset? Quick asset means from the current asset we are removing prepaid expenses and the inventory. Again, the cash ratio. The cash ratio here is 0.75. So what it indicates that this company can cover 75% of its current liabilities by using only cash and cash equivalent. That means by using only the cash and cash equivalent, this company can set off 75% of its current liabilities. Again, the working capital. So overall, what we can say that this company is in a better liquidity position. Again, the position can be finalized or you have to consider the industry benchmark or our previous performance also. So as a practice, what you can do, you can download this PDF file from the description below and you can practice yourself these ratios, and you can calculate the ratios for year 1, year 2 and year 3. So then you will become more familiar with the ratio analysis, and you can see how the ratio is behaving from year to year. So you'll get a really good insight into how this liquidity position is behaving from year 1, year 2 and year 3. We'll move into next category of ratios, that is leverage ratios. So the important leverage ratios are total liability to equity ratio and the debt ratio, long-term debt to equity ratio and interest coverage ratios. So the formula already given here in the formula for total liability to equity is total liability divided by equity, and the debt ratio it is total liability divided by total assets, and the long-term debt ratio it is long-term debt divided by equity, and the interest coverage ratio that is EBIT divided by interest expenses. So we'll calculate one by one. So in this example, total liability to equity. So where we can get the total liability and equity, it is from the balance sheet. You can see in this case the total liability is here. Total liability is 4,900 divided by total equity. That means 6,100. 4,900 divided by 6,100, that is mean 0.8. So what this indicate that if this ratio is below 1, it indicates that the most of the company's assets are financed by the equity. If it is greater than 1, what it indicates that the most of the company's assets are financed by the debt. So in this case, it is below 1. So what it indicates that the most of the company's assets are financed by the equity. So we'll move into next ratio, that is debt ratio. The formula for debt ratio is total liability divided by total asset. So you can see total liability we already taken for this example. So it is 4,900. So we can get the total asset from the balance sheet here, that is 11,000. So the ratio is 0.45. So what is indicate that? How much proportion of total company's asset are financed by the debt? So, if this 4.5 indicate that the 45 percentage of company's assets are financed by debt and balance remaining 55 percentage is financed by the equity. Then next ratio is long-term debt equity ratio. So it is similar to all liability to equity ratio, but in the long-term debt equity ratio, we are considering only the long-term debt. So you can see the long-term debt in the balance sheet is 2,500. So the ratio is 2,500 divided by 6,100. That had been 0.41. In the long-term debt equity ratio, we are considering only the long-term debt only, and we are comparing the long-term debt with the equity. So the fourth important ratio is interest coverage ratio. That means how many times the company have ability to cover or pay its interest by using its operating income. So you can see the example from the income statement, the value from the income statement. Here total interest expense is 400 and the EBIT is 3,507. So the formula is 3,570 divided by 400,000. That means 9. This 9 mean what it indicate that this company have ability to pay its interest expenses 9 times while using its operating income. So you can see the similar analysis what we analyzed here, that you can go through this analysis and even you can prepare the complete analysis for year 1, year 2 and year 3. So you'll be more familiar with the leverage ratios. So next we will move into profitability ratios. Profitability ratios is always measuring the profitability, how the profit or how the cost structure is behaving from time to time. So in this analysis, we prepare the profitability ratios only for the year 3. So you can prepare yourself it's for year 1 and year 2 to be more confident with the profitability ratios. So the GP ratio, operating profit margin ratio, net profit margin ratio, again the return on asset, return on equity and EBIT margin. So the GP ratio, that means gross profit divided by sales into 100. The operating profit is operating profit divided by sales into 100. Net profit ratio is net profit divided by sales into 100. Again, the return on asset is net profit divided by average total asset into 100. And return on equity is net profit divided by average equity into 100. And the EBITDA margin, that means EBIT plus depreciation divided by sales into 100. So we already prepared the calculation for this. So in the GP, so you have to take these two, GP, gross profit and sales, from the income statement. So when you go to income statement, you can see that here the $14.5 and the GP 6,000. So that means 41%, 41.38%, that is gross profit margin for year 3. And the operating profit margin is 27%, 27%. And the net profit margin is 15%. So this we can calculate is with comparing with the sales value, how much proportion of sales is gross profit and how much proportion is operating profit and how much proportion is net profit. And so other important ratios, return on asset and return on equity. So in this return on asset and return on equity, we are taking one value from income statement and another value from the balance sheet. So there is a rule for ratio calculation. If you are taking one value from the income statement and one value from the balance sheet, you always to average it, the balance sheet value. I mean, as you know, the income statement we are preparing for a period of time, but the balance sheet is for a point of time. So to be comparison or the ratios to be more accurate, you have to take the average value from the balance sheet and the actual value, the present value, from the income statement. In the return on asset, the formula is net profit divided by average total asset. Again, the return on equity, the formula is net profit divided by average equity. So here you can see that net profit the 2290 divided by the average total asset. So how you will get the average total asset? We have to add the current total asset and the previous period total asset, and you are to average it. You have to average it. Then only you will get the average total asset. You can see the total asset for the current year is 11,000 and for the previous year is 9,570. So you have to average these two value to get the average total asset here. That is mean 10,285. So the return on asset here is 21.5%. And the return on equity also similar way. You have to average the current balance sheet value with the previous balance sheet value to get the average of the return, to get the average of the equity. So the similar way you can calculate the equity as well here. That is 2,290 divided by 5,710 into 100. That means 38.8%. Again, the EBITDA margin, all the values we can get the income statement. So we have to add EBIT plus depreciation and we have to compare it with the sales. So it is 28%. That is EBITDA margin. So the important thing in the profitability ratio is when you are taking one value from the income statement and other value from the balance sheet, you should average. If the average asset value or average equity, average liability value is already given in the examination or in already given in the question, you can directly take the average value. So here is the similar analysis what we discussed. So here is the similar analysis what we discussed regarding the GP, operating profit, net profit, return on asset, return on equity, EBITDA margin. You can go through this. So next we will move into efficiency or activity ratios. So the key ratios are here the inventory turnover ratio, inventory in days, receivable turnover ratio, receivable in days, payable turnover and payable in days, and the total asset turnover. Here also in the activities ratios also, we are always taking one value from income statement and another value from the balance sheet. So the thumb rule is from if you are taking one value from the income statement and other value from the balance sheet, you always average it the balance sheet item. So the formula for inventory turnover ratio, it is cost of goods sold divided by average inventory. So in our case, the cost of goods sold is, you can take it from the income statement, that is 8,500, and the average inventory, it is 1,800 and 2,200. So you have to average these two. So that is mean 8,500 divided by 2,000. That means 4.2 times. So which indicate that this company is selling its inventory and replacing 4.25 times per year. So by using this same inventory turnover ratio, we can convert this into number of days. So the formula for inventory in days is 365 divided by inventory turnover. That means 365 divided by 4.25. That means 85 days. That means what it means that this company is taking average 85 or 86 days to convert its inventory into sales. Again, all these ratios should be analyzed or compared with the industry benchmark or industry standard or previous year performance to get a detailed analysis how the company is performing, how the ratios are moving, it is increasing or decreasing, the performance level is getting down or getting better. So to get all this insight, definitely we have to compare the ratios with the industry benchmark and the industry standard. Again, the next ratio is receivable turnover ratio. The formula is sales divided by average account receivables. So you have to take the sales from the income statement, that is 14,500, and the receivables from the balance sheet. The opening receivable is 1,500 and the closing is 1,800. So you have to average it out here. That means 14,000 divided by 60, 1,650. That means 8.79 times. That means this company is collecting 8.79 times per year. I mean, receivable turnover is 8.7 times per year, which means this company is collecting its receivable 8.79 times per year. So if I can simply convert this ratio into number of days, that means 365 divided by 8.79, that means 41.53 days. So what it indicates that this company is taking on an average 41 days to collect the receivable after the sales. Again, the payable turnover ratio. The payable turnover ratio, the formula is cost of goods sold divided by average account payable, or purchase divided by average accounts payable. We can calculate this in two ways. So if your cost of goods sold is matching with the purchase amount, you can directly take the cost of goods sold, or if it is not matching, you have to take the purchase value here. So in this example, I am considered cost of goods sold as the purchase value. So in this example, I consider cost of goods sold as the purchase value. So you can get the cost of goods sold from the income statement, that is 8,500, and the average accounts payable is 1,200 and 1,400. So as an average, it is 1,300. That means 6.54 times. So what it means that this payable is turnover is 6.54 times. So please read this as payable. This is payable turnover, not receivable. So it is 6.54 times. That means this company is paying off its payable 6.54 times per year when we are comparing with the average account payable. So you can easily convert this payable turnover into number of days, that is 365 divided by 6.54, that is 5.55.8 days. That means 56, let's say 56 days. That means after the purchase, this company is taking 56 days to pay its payables. Again, the total asset turnover ratio. Total asset turnover ratio, you can calculate the sales divided by average total assets. So the sales is 14,500 and average total asset is 10,285. That means 1.41 times. That means this company is generating 1.41 times of revenue when it's comparing into the total assets. So this is a similar analysis what we discussed now. So let's move into the next category of ratio, that is market ratios. Important ratios are EPS, that is earning per share, and the dividend payout ratio, retention or clawback ratio, and PE, price to earning ratio. So the EPS, what EPS measuring is showing the how much the company is earning per share. So in this income statement, the number of share is not given. So let's assume this company have 1,000 shares. So the earning per share is grown from 1.3, that is in year 1, and when it's come to year 3, it is 2.22. You can see if it's divided with this with number of share, that is 1,000. So it is 1.3 in the beginning and it is 2.2 in the year 3. And the dividend payout ratio, how we are calculating dividend payout ratio? Dividend payout ratio is how much percentage of net profit is declared or paid as dividend. So in this example, it is not given the exact number of dividend payout. So we'll just cover up the formula here. The formula is dividend divided by net profit. And the retention or clawback ratio is how much proportion of profit, company's profit, is retained in the business for the future growth. So it is 1 divided by dividend payout ratio. 1 means the 100% is the 100% or 1 is the total net income the company earned. So we have to reduce the payout from the net profit to get the retention ratio. Next, the PE ratio and or price to earning ratio. The formula is market price divided by earning per share, EPS. It is comparing the company's earning with the market price. Again, it is very useful when we are comparing, very meaningful we are comparing with the industry peers or with the industry benchmark. So what we discussed today, we came with an income statement and balance sheet, and we have prepared the liquidity ratios, leverage ratios, profitability ratios, activities ratios, and we have discussed about the PE market ratios as well. So the liquidity ratios we discussed many times is measuring the liquidity or short-term solvency of the business. The leverage ratio is long-term liquidity or the long-term solvency. The activity ratio is how the operational efficiency is managing by the company, that is measuring by the operating ratios. The profitability ratio is how the profitable, how this business is profitable, and how the cost structure, how we are managing the cost, how we are generating the return. These all measuring from the profitability ratios. So finally, when it's come to market ratios, this is measuring a company, or this is connecting the market or the share market or share price with the company's profit and loss account or income statement. So the PE ratio is always measuring the ratios from an investor's point of view. So that's about today's discussion. If you have any doubt or you need any clarification from any of this topic, please comment on the comment section. Again, I'm attaching this PDF in the description below. You can download and you can refer and you can practice more ratios by using this income statement and balance sheet. Thank you for watching this video.